and investors, Tradeplus brings you well-crafted technology and tools backed by over 25 years of trust. We believe that investing and trading in stock market should be simple and rewarding, and that has been the relentless pursuit of the team at Tradeplus.
You may be a pro trader or a veteran investor or someone who is still figuring out the stock market. Tradeplus is a great place to look.
We continuously improve your experience by bringing out carefully thought out features, tools, convenience, and app experience. Rocket, our intuitive and feature-rich trading app, comes with an amazing tools specific for early starters, growing and budding traders, and experienced option traders.
We care about every investor and every trader. We understand the struggles you face and they need to be there for you. That's why we delight in providing amazing customer experience with real people.
While you can get help from our WhatsApp chat 24/7 on all 365 days, we are also happy to receive your call when you like to talk to someone. We are also just a mail away from you.
We are growing steadily as we meet the demands of many people like you day in and day out.
We may not be the biggest in the industry. We take pride in being better than the best when it comes to serving customers in India and abroad. We are good people to trade with. That's what our clients tell about us.
You can add Srikanth sir as co-host, sir.
We at Tradeplus value your time and your money, which is why we never give tips. Rather, we encourage you to be informed, to be involved, and to be in touch with your investments.
We are here for you. Call us when you need. Connect with us.
To enjoy our service, open free demat and trading account and enjoy world of opportunities to invest and trade in one of the emerging markets in the world.
Try our Rocket app for free. Download to experience and enjoy the tools made just for you.
Trade like a pro. Trade with Tradeplus.
Sir. Can you hear me, voice? Yes, sir. Yes, sir. Kindly make Srikanth sir as co-host, sir. Yes, sir. Okay. Yeah, you can make Srikanth sir a co-host, sir. Then only he can unmute. Yeah, one second.
Good evening, everyone. Welcome to this exclusive webinar by Tradeplus and MCX. This is part 2. In the first part on December 2nd, we had the basics of trading in commodities done by Mr. Srikanth, and today he's going to take us to the next level as we look at the advanced modules of trading in commodities. But before we get into that, just want to welcome everybody who's here in Zoom, as well as for people who are joining us via YouTube. Thank you for joining us, and we hope that this will be a time well spent for all of you, that we'll all learn together and we'll be able to become better in learning and trading. So just some house rules before we get into the webinar. Would request everybody to stay muted. Okay, keep your mic on mute so that any background noises or voices will not disturb the webinar. Also, we request you to switch off your camera because that will add to the bandwidth, and sometimes there could be a lag in Zoom. So there is no need for anybody to switch on your cameras. So kindly switch them off and you can participate, and the speaker and those who are conducting will switch on as and when required. But otherwise, would request everybody to stay on mute and also to switch off the cameras. There will be plenty of time for question and answers at the end of the webinar. You can start writing your questions in the chat box even as the webinar takes place. Keep the questions coming, and at the end of the webinar, Mr. Srikanth will take every question and try to answer. If possible, if it is at an appropriate way, he may also take some of your questions during the webinar and also answer it. We did it last time and it worked out very well. So would encourage everybody to follow suit in that. Now, before I talk a little bit about Tradeplus, I would like to just ask everyone here. Some of you, I believe, are joining us today. So if this is the first time you are joining us in a webinar, we had one on December 2nd, but if you didn't participate in the first webinar, but you have joined us for the second webinar, I would like you to say yes in the chat box. If you are joining with us for the first time for this webinar, then I would like you to say yes. Thank you. I can see a couple of people. Okay. Anupam was there and Mukesh also was there. Thank you. Thank you for saying that. That helps us to understand, that we have some new people today, first time. So it will help our speaker also to start in the right way. Well, coming back to Tradeplus, most of you are probably our clients, but for people who are connecting with us for the first time, we want to thank you for joining us and giving us an opportunity to showcase our capabilities and ourselves. Would encourage you to visit our website and download our app, Rocket, and try it. There's a guest user option. You can try that and you can experience the product even before you sign up with us. And not to mention that we are the pioneers of the flat plan in the industry, and we have been doing it very well. Our customers are enjoying our flat plans, and we have a plan for people who are starting out in options and futures and options, and that's starting at 99 rupees. And for people who do more than 70 trades in a month, there's another plan called 499, and both of these are amazing plans, and we would like you to take advantage of that. And at the end of this webinar, if you have any questions, please post them during the webinar at the end. And if you have specific questions to account opening, you can talk to us as well. Right. So thank you one and all for joining. And I think some more participants are joining us. They are en route, but we would like to start so that we give Mr. Srikanth enough time. So Mr. Srikanth, just for people who are new here, a quick thing about Mr. Srikanth. Mr. Srikanth is a fellow member of the Chartered Institute of Management Accounts UK and has over 25 years of diverse experience in finance, capital markets, especially in the areas of audit, research, ERP, MIS, and corporate training. Currently, he's leading the training and education function at MCX, Multi-Commodity Exchange. And we are so grateful to you, Mr. Srikanth, for doing this for us. And in collaboration with MCX, Tradeplus is happy to conduct this. And we look for many more such opportunities where we can collaborate and we can serve our customers together. So thank you, Mr. Srikanth, and over to you, and looking forward on behalf of all the participants to learn something wonderful today. Thank you.
Okay, thank you very much for the warm welcome. Yes, nice to know that some new people have joined. I'll do exactly, we do have a problem with bandwidth, so I'll remove my ugly face from the screen, but I'm here, you'll be hearing my voice. Now, first thing I'll do is I'll share the presentation that I have, which I'll be using today. Okay, in case you're not able to see the PPT, just let me know, but I think everyone should be able to see that. Now that I know that some of you have joined for the first time, I'll take it a little easy for the first couple of slides to make sure that we are on the same page, and then we'll address right, then I'll address the remaining the main program today, which is on strategies. So we look at some strategies and then we will see how to take that ahead. Yeah. So a couple of things, like I said, based on advanced options. Some of you who have joined today must have missed the basics of options that we did last time. So I've got a couple of slides just to basically I had put them in here from the point of view of just to for continuity, but perhaps it will help those who have joined for the first time. So first of all, when you talk about options terminology, we have something called options price. Now this options price is really the premium. Okay, so when you in options, you pay a little bit of money and you buy a right to buy something in the future, or right to sell something in the future, and this amount of money that you pay to buy this right is called a premium. So we have call options and put options. So if you pay money to buy a right to buy something in the future at a pre-agreed strike price, then that would be called a call option. If I buy the right to sell something in the future at a strike price, at a pre-agreed price, then that would be called a put option. Yeah. So for both the call options and the put options, anyone who buys the right, then there has to be an opposite side to that person. That person would be known as a writer. Meaning, if I pay money to buy the right to buy, then someone accepts that money and he is going to be obligated towards that contract. So the person who is obligated towards the contract is called the writer of the contract or the seller of the options contract. So we always have a buyer of a contract and a seller of a contract. Now, options are derivatives, and whatever you're buying and selling at a point, at a price that you think is going to be the price on a date in the future. So in other words, all contracts have got an expiry date. The date is very clearly mentioned, and it is, in fact, the contracts are known by the expiry date. So I can have let us say, 31st January 2023, contract, which means that the contract is expiring on that date, and the contract will be known by the date on which the contract expires. So the date specified in the options contract is known as the expiry date, and the exercise date and the strike date or the maturity date. Now, the reason for this difference is because of the type of contracts that we have. We have American contracts or the European style contracts. The ones we have are in India, we have European style contracts, and hence the expiry date, the exercise date happen to be the same. Yeah, that's the date of or the maturity date. The strike price is the price at which I am agreeing to trade. So if I'm paying you money now, called a premium, to buy something in the future at a particular price, that price is called a strike price. And the other party agrees to come and trade at the same price, the same strike price. Open interest is basically the number of people who are connected with the commodity. Yeah. So if I buy a contract, someone sells a contract, open interest is 1. And somebody else sells the same contract and someone else buys the contract again, then open interest goes up, becomes 2. So generally speaking, as you are approaching the end of a contract, when the contract is about to expire, then you will see that the open interest normally comes down a little bit. Yeah, so it starts coming down. So during the beginning of a contract and as you progress within the contract, you find the open interests are very high, and then later on, subsequently, you find them coming down. Now, there's something called moneyness in options contracts. So moneyness is about, after having taken a position, are you in a better position or a worse position? So if you're in a better position after having entered the contract, then you're in the money. And if the position has not changed, then you're at the money. And if you're worse off, then you're out of the money. So for example, if I buy the right, so by paying a premium, I'm buying a right to buy something in the future at 1,000 rupees. So I'm buying a right to buy at 1,000 rupees. The 1,000 becomes a strike price in the month of February of next year. And if the underlying price, that means the price of that particular item that I'm buying, if it is it higher than the price at which I have contracted? If it is, then I'm in the money. If it is lower than the price at which I've contracted, then I'm out of the money. Okay, so we can look at whether I'm in the money or out of the money or at the money from the point of view of the position that I've taken. So in options, there are only 4 positions that you can take. You can be a buyer of a call option. You can be a writer or the seller of a call option. You can be a buyer of a put option, and you can be the writer or seller of a put option. So there are only 4 positions that you need to understand thoroughly before you actually embark on trading on the commodity markets, in the commodity options markets. So the only other thing about options in India is that the commodity contracts that we have, they're called options on futures, which means that the options contract, when they come to an end, if you have not undone your position, then your position, or rather when you have not squared up your position, then your position will devolve. Devolve just means that it will convert into a futures contract. Yeah, so the minute an options contract comes to an end, your positions can convert into a futures contract, and then you can stay with that futures contract for a few days until expiry. And when that contract expires, you can opt for delivery on the futures contract. Now, the underlying for an commodity options contract in India is the futures contract. Okay, I'll come again here. Now, there is a futures instrument and the options instrument on the commodity exchange. When it comes to the futures instrument, the underlying price is the spot price. So when I buy a futures contract, I'm buying at a price that I think is going to be the spot price on the date when the contract comes to an end. So, and hence the underlying for a futures contract is the spot price. However, when it comes to trading in options, the underlying for an options, commodity options contract is the futures contract. Why? Because the options contract, when it expires, it devolves into a futures contract. And hence, when I trade options, I am looking at what the future price is going to be on the date when the options contract expires. Okay. So it sounds complicated at the moment, but once you get your teeth into it, you'll find that it is nothing complicated. Yeah, the trading hours, they correspond to the futures contract, because after all, the underlying is the futures contract for options. So we do trade long hours. We trade from 9 in the morning till 11:55 currently, but we have this daylight saving hours in the US, so we actually we go by that. So for 6 months we have trading until 11:30 p.m. in the evening. Otherwise it is right like currently 11:55 p.m. That's a trading hours, and they correspond to the futures contract. The reason for that, I think I explained in the previous session, which was that your options on your commodities which are traded, they are always their price discovery is happening in international markets, because the prices are discovered in the international markets, and the pricing in the international markets has an impact on the price in the local Indian market, and hence we keep the exchange open till midnight, almost midnight, so that people can adjust their positions based on the prices which have changed in the international markets. So in other words, the price discovery of most contracts is coming from the international markets. The daily settlement, so there is an options premium. That means the minute I buy an options contract. Now, when I say buy an options contract, I could be buying a call option, or I could be buying a put option. Yeah, so it could be a buy or call or a put. Only thing is, the commonality is I'm buying. So when I buy, then I need to pay a premium. And that premium at T+1 gets transferred to the writer or the seller of the contract. That means if I buy a call option today, I need to pay the premium to lock into that particular strike price. And the money I pay, called a premium, goes to the writer of an options contract tomorrow. Today being the trading day, T+1 means trading day +1. Tomorrow, he gets the premium in his account. The final settlement or exercise options positions, it devolves into underlying futures position. If you have a long position in options, a long call, a call is right to buy. Yeah, so it's a long call means I've paid money and I've bought the call. I've bought the right to buy, because if I have a right to buy, when it devolves, it becomes long in futures. Yeah, it becomes a buy position in futures. If I go long put, that means a right to sell, same as when once it devolves, it becomes short in futures. Okay, now short call. So when I'm short call is a writer of a call. Yeah, so when there's I'm seller of a call is called of a option is called a short call. So he's a forced to sell. Short call is a person who is forced to sell. So he's a seller. So he becomes a seller in the futures contract. And similarly, a short put becomes the buyer in a futures contract. So this is the devolvement happens if at delivery, but this is important from the point of view of people who take delivery or give delivery. Generally speaking, majority of the persons who trade, they come to the market to hedge their risk. Now, when you are hedging the risk, it does not necessarily mean that you need to take or give delivery. You can still be hedging price risk. So because you're hedging price risk, choice is yours whether you wish to take delivery or not. Yeah, so that is a different issue regarding wanting to take delivery. But there are strategies where people like to give delivery or want to take delivery as part of their strategy. But that we will come to at some different point in time. But at this moment, I just want you to know that the positions that you have taken, these are the positions: long call or long put. This is like buy, call, sell, buy put, sell call, sell put. These positions that you have taken, if you hang on to these positions right up to the end, they devolve into futures contract, because they devolve into futures, and this is the position that you end up with at the after the devolvement that takes place. So someone was just asking in the chat box a while ago, which are the commodities that we have in options. So we have gold options, and we've got silver options, we've got crude oil, natural gas, we've got copper, zinc. Now nickel is not there at the moment. Yeah, we're not. It's not much trade there because there's some issues with that. But we have the rest of them: gold, silver, crude oil, natural gas, and copper. Now these you have the something called an underlying futures, because these options contracts, when they expire, they convert into the underlying futures. In a gold contract converts into the gold 1 kg futures contract. When we talk about the futures contracts, we have a number of futures contracts. We got the 1 gram petal gold futures contract. We have the Guinea contract. We have the 100-gram contract, and so on. But the options contract is linked to the 1 kilogram contract, and the silver contract or silver options contract is converted into a 30 kilogram silver contract. These are the big contracts. The crude oil, it converts into 100 barrels, okay, and the 100-barrel crude oil futures contract. So here is just basically telling you what the underlying is, and whatever the underlying is at the time of expiry, the options contract converts into that particular contract. What you're seeing right now is a snapshot of the contract specification. The contract specification is the product of a commodity exchange. Just like a car is a product of a car manufacturer, similarly, a contract specification is the product of the commodity exchange. So what are we offering to the market? We are offering a contract specification which people can trade on. So all contracts have got an expiry date, and they all have an underlying, just like a futures contract. They have, more importantly, what I want to talk about is, of course, I've already mentioned European style, but they got a strike price. The strike price, we have 25 in the money, 25 out of the money, and 1 at the money for gold and silver, which means that I have 51 prices available on which I can trade. I can trade on any one of those 51 strike prices. Okay, these 51 strike prices which are there, they have the strike interval of 100. So you can have 50,100, 50,200, 50,300. So you can see the interval is of 100. So I can choose, let's say I choose 50,500, and I can buy a call, which is a right to buy, at 50,500. And the other party who will receive the premium and is obligated to the contract, he will accept the premium at T+1. In other words, if I trade now at 50,500, by paying a premium, the premium will reach the writer of the options contract tomorrow morning. Yeah, so this is how the premiums will be moved. And the strike price intervals are different for different commodities. For gold is 100, for silver it's 250, crude oil, the interval is 50, natural gas is 5, copper is 5, zinc is 2.5, 2 rupees 50 paise is the interval between the price. There's a tick size. Tick size, it just means that how much I can buy the contract at. For the tick size for gold is like 50 paise, yeah, gold and silver. So the tick size is 50 paise tick. And similarly for natural gas is only 5 paise. The tick size for copper is 1p, 1 paise. Zinc is also 1 paise. The daily price limit. So we have a daily price limit, just like in a futures contract, we have something called a DPR range, daily price range. So all trading takes place at that particular range. So daily price range, the upper and lower band, are determined based on the Black 76 model, relaxed considering the movement in the underlying. So their trading takes place at a particular level. Yeah, so there's a daily price limit there, especially for the futures contract, and the same thing is happening here. The initial margins, they are, as far as the buyer is concerned, is upfront premium is blocked. So only the premium is blocked as far as the initial margin is concerned for the buyers of calls and buyers of put. And there's margin money blocked as far as the writer or the seller is concerned. Here I would like to just say that the margin monies which are blocked for the writers, that money is released in its entirety at the expiry of the contract, or when you come out of that particular contract, when you take the opposite position on that contract, then that money is comes out of that particular contract. Position limits. So we have position limits in the futures contract. In the futures contract, we have something called a position limit. These limits are there for members, and these limits are there for the clients as well. They're different limits. They're higher limits for members, lower limits for the clients of members. So most of you who are here today in the webinar, you are clients of our member, and the clients have got lower limits as opposed to the limits which are there for the member. Now, the point here is that for commodity futures, whatever limits have been specified in the futures contract, in options, that limit is twice that amount. Yeah, it's twice that limit. The other thing to consider is when a contract expires, and if your position converts from options back into futures and the expiry date, at that time you're given 2 days to cut your positions and bring it in line with the position limits which have been set for the futures contract, because after expiry you become a futures trader, and hence your limits are as per the limits of a futures contract. Yeah, now there's a daily settlement for premiums. Premiums settle every day. M2M in mark to market on options positions, they are adjusted with the margin requirements. There is no adjustment to be made as far as price movement is concerned for the buyers of options, buyer of a call, buyer of a put. But however, for the writer, they are actually settled in cash. The gains and losses would not be settled in cash on a daily basis, right? It happens only at the end. Settlement on exercise options positions devolved into futures. Okay, we have done that. Here I just want to, again, I think I showed this to you last time. I'll again show this. Suppose I have a futures contract which is expiring on the 3rd of February. Then you may have an options contract which is expiring a few days earlier. And the minute the futures your options on futures contract expires, it devolves into a futures contract. So it devolves on the same date of the expiry. And for this duration, the trader becomes a futures trader, and at the expiry of the futures contract, he can take delivery. So underlying is in the near month futures contract. So when I'm trading in futures, options on futures, the benchmark is the near month futures contract, meaning the futures contract which is closest to expiry from the expiry date of the options on futures contract. So options on futures contract, I look at the expiry date, then I search for the futures contract which is nearest to this expiry, and that would be the futures contract, yeah, which is already there, near month futures contract, and then it devolves into futures, and delivery of physical commodity happens only at the expiry of the futures contract. Okay, and of course it all depends on exercise options, and depending on whether you're in the money or out of the money, that has an impact on whether you will get delivery or not. So now I'm coming to strategies. Yeah, so whatever I've spoken so far is something that I have probably covered in the last session, but today I'm looking at some strategies. We look at some of the hedging strategies, and then I will look at some of the combination and spread strategies. Yeah, so this is what I'm going to cover now. First of all, when I'm talking about the hedging strategies, so we need to understand what we mean by hedging. So you see, prices are very volatile. Yeah, prices are always very volatile. And assuming I'm here where it says today, and this is the price today, whatever the price might be there, that's today's price. I need the commodity at the end somewhere here, or I need this commodity to buy, or I need this commodity to sell at a point in time in the future. Now, I'm sitting here today and I do not know whether the price is going up or the price is going down. So the price could go down or the price could go up. Uh, if I am, for example, a consumer of the commodity, then I will be very happy if the price collapses. Yeah. If I am a user of the if I'm a producer of the commodity and I'm a seller of a commodity, I would be very happy if the commodity prices go up there. And it all depends on who you are and for what purpose you need the commodity, and hence you can identify this whole area as the risk. Um, uh, I think I'm just reading. Okay. 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 There's something internal operational issues. Some questions have been asked. Okay. Anyway, the point here is that this is the risk that we are talking about. Yeah. So this can be overcome by using derivative instruments, and we are of course right now looking at options as an instrument to hedge the risk. So let's just look at how this can be done. So the whole idea is that here I am sitting today, I don't know which direction the price is going to go, and hence this is a risk that I'm anticipating. So let me see what I can do to manage this risk. So there are some strategies. These are known as options hedging strategies. So I can get protective put strategy or a covered call strategy. These are strategies which help the users of commodities. And when I say users of commodities, it can be anybody who is either a seller of the raw material or the buyer of a raw material. He could be an importer or an exporter. He could be someone who's processing their raw material. So anyone who is connected with the physical commodity, he can be a hedger. If I am not interested at all in the raw material or the commodity, but I still come and trade on a commodity exchange, then I am not a hedger. I am a speculator or an investor. So you must know how to differentiate between a hedger and an investor or a speculator. Speculators, they don't want the commodity. They only want to make money on the price movements of the commodity. Whereas a hedger, he's looking at locking into the price and trying to mitigate his risk. So here I just want to tell you one thing. A hedger who comes to a commodity market, his aim is not about making money. He's only basically locking into a price so that his cost of production will get impacted. Whereas a speculator will come into the commodity market, trade, and try and make some money. So we look at it from a commodity perspective. We always say that the hedger is trying to reduce his risk, whereas a speculator is trying to maximize his risk, is maximize his profit. And if you want to maximize profit, then your risk is also getting maximized. So risk and return, yeah, this is what we're talking about. So more risk you take, more returns you'll get, higher the returns you'll get. But a hedger is not looking at have huge returns. He's only looking at locking into the prices, and hence the risk is mitigated or reduced for a hedger. So let's look at one of these strategies. I'm looking at the protective put strategy. The prices here of gold, 45,000 is almost mouth watering because the prices today are all 50 plus in not 45,000. But it doesn't matter. We are just using these figures to understand this whole concept of protective put. So imagine I am someone who has purchased goods at a price of 45,000. Yeah, 45,000 here means a price of 10 grams, tola, 1 tola as we call it in India. We buy 10 grams for 45,000. Now, we are not looking at the quantum that has been bought. Someone might have bought a ton of it for all that matters. But we have the price someone has purchased physical gold 45 at the rate of 45,000 rupees, 10 grams, whatever the quantum he has purchased, he has got it with him. Now, once you buy this commodity, then you're frightened that the price will go down. See, after I have bought it, what happens if the price goes down? That is the worry. It's something like, imagine you were to buy a house, and your worry is that after I buy a flat or a house or a car or some asset, what happens if the price goes down? That is a worry at the back of your mind. Of course, with a house, the values don't seem to go down much. Not like a car. In a car, you buy a car and the value can go down. But gold, it can move any direction. You might make some money, you might lose some money. But here in this particular situation, someone has bought gold at 45,000 and then he buys a put. A put is a right to sell. So he's bought a right to sell at 44,900. Basically, what he's trying to say is that if the price falls, then I am actually locked into a selling of at the rate of 44,900. My loss is going to be limited to 100. So let us see the payoff of that, how it works out. Now, imagine I have bought this at 45,000. The price could in the future can be any one of these prices. I can't tell at the moment what the price is going to be in the future. It could be 44,700. It could be 45,300. Yeah? So it could be any one of these prices. Now let's look at the physical side. I've bought it at 45,000. Price drops to 44,700. So am I happy or am I sad? I better be sad because I have bought it at 45. Price has fallen to 44,700. I'm 300 rupees sad. If I buy at 45,000 and the price has gone up to 45,300 right at the bottom here, then I'm going to be happy. I'm going to be 300 rupees happy. So basically, we're going to look at each one of these situations and see how this is going to turn out. So if I look at the first one, this is what is happening. I buy something at 45,000. If the price in the future becomes 44,800, then I am unhappy, 200 rupees unhappy. I'm sitting on a loss of 200 rupees. Price, I wish I had not bought it there because the market price has fallen. So these are different market scenarios. I'm not sure what the price is going to be. It could be any one of these. But I have hedged by buying a put at 44,900. So I traded at a strike price of 44,900. Remember, we have in gold, we have something like 51 strike prices. I chose 44,900 as a strike price on which to buy a put. So I buy a put at 44,900 by paying a premium. Now, in this calculation here, I have not included the premium because I want you to focus on the strategy. So I have bought a put at 44,900, which is a right to sell. Now, I have a right to sell at 44,900. Market price is 44,700. Will I exercise my right to sell? I will exercise my right to sell because if I exercise my right to sell, I will get 44,900. If I sell it in the open market, I will get 44,700. Now, I'm assuming that this is going to be the price. So here, I will be better off by 200 rupees. Now, if the market price is right at the bottom here, 45,300, I have a right to sell at 45,900. Now, I will not exercise my right here. I just walk away from this particular contract, and the loss I will suffer would be the premium that I've paid. So if I look at the payoffs would look something like this. If the price goes up to 44,800, I have a right to sell at 44,900. I will exercise my right and I'll get 100 there. However, at all the other prices, I'm not making any money because I will not exercise my right. Now, for those of you who have joined for the first time, let me just again, maybe I should emphasize on this. When somebody buys a call or buys a put, he only buys the right to buy in a put option or buys the right to buy in a call option. In a put option he buys the right to sell. Call option he buys the right to buy. So once he has entered this, he does not have any other obligation. If he wishes, he can walk away from the deal. So that is the nature of our options buy positions. In this case, his buy position is buy put, so he's a right to sell. But he has no obligation to sell. He has only got a right to sell at 44,900. So if the price in the open market is 44,300, he will not exercise. He'll just walk away from the deal and because he's not obligated to that contract. So if I look at the net position, it becomes something like this. If I add these two rows, this is what I get. Now, you have to understand what I have done here. What has been done here in a protective put strategy is that if prices fall, my loss is limited to 100. Yeah, if even if I were to take 44,600, 45, 44,500, any other prices there, and I had done these calculations, I would still get 100. So basically, if prices fall, the maximum loss is 100 per 10 grams. Okay, and if prices were to rise, then of course I end up making money. Now, this is called a protective put. It's almost like an insurance. The buyer of a physical commodity has locked into a price in such a manner that the maximum loss he could make in this example would be 100. So he has obviously done his sensitivity analysis and he knows how much loss he can bear. And based on that, he has decided to buy a put at that particular strike price. Okay, he has got number of strike price to trade on. He chose this particular strike price because he knows that he can't bear a loss more than 100, and hence he chose that particular strike price. So this is known as a protective put strategy. Why? Because I'm using a put instrument and it is protecting me on the downside, and hence it is called a protective put strategy, which basically can be depicted in the graphical form. It basically says that if the prices were to, there's a price line here, if the prices were to drop, the maximum loss would be 100. If prices were to rise, then it can be a very large amount depending on how high the price has gone. So this is one strategy that I've just now explained to you. There are many hedging strategies. There's something in the chat. Let me see if I can take that. So someone has asked, so when the price goes to 45,300, would he lose the value paid for the put? Let me go back again. When the price goes to 45,300, can I go back there? Yeah. So if the price goes to 45,300, yeah. So what is happening when it's go 45,300? He's going to sell in the open market at 45,300. Okay. And so he has bought it at 45,000. So here he loses the premium paid. If he has whatever premium he's paid, that is his only loss. Okay, so as far as this gentleman is concerned, his only loss would be the premium he has paid. Let me see if there's anything else that you wanted to know. Okay, right. Okay. So you asked me if that is the assumption. Yes. That is the assumption for all the options. Yeah, so it is not just for this. It is not a assumption for this particular options contract. It is a common thing for all options contracts where the buyer of an option, whether it's a call option or a put option, his loss is limited to the premium he pays. Okay, and the profit is unlimited depending on which direction the price will move. Okay. So when you're talking about hedging strategies, I'm just opening a couple of them here. So you can see there are different strategies. They got different names. The one I just now looked at, the one we just now went through, that is the second one. Yeah, it's called a protective put strategy. Yeah, you have a physical commodity and you buy a put to manage that risk. You can use a call. You can use a call instrument. So you can write a call if you have a physical commodity. So basically the point here is that you need to have a physical commodity to be considered as a hedger or a hedging strategy. If you don't have a physical commodity, then you cannot be a hedger. Okay, so it could be a speculative a strategy. Now, here's another one. It says covered short put strategy. Someone intends to purchase the physical commodity, even though he doesn't have the physical commodity at the moment, but he intends to purchase it. Sometimes what happens in some, it could be some company, they need the commodity, the physical commodity, but they don't need it now. They may need it next month. Okay, but they're still worried or they're still concerned about the price movement that could happen between today and the time when they actually purchase the physical commodity. So they can still come to the derivative market and they can sell a put, yeah, for a position that they have yet to procure. Yeah, they have not yet purchased the physical commodity, but the minute they buy the physical commodity, whatever the price, they already have manage the risk by selling a put on that. But message that I want to send here on this particular slide is that if you want to be a hedger, you should have a physical commodity, or you should have the intent towards a physical commodity. Now, when I say buy a physical commodity, it can also be sell a physical commodity. So, for example, a farmer who has not yet harvested his crop, so he doesn't have the physical commodity, but he knows that he's going to harvest the crop in 2 months' time. So at that point in time, he will have the physical commodity. The fact that you're connected with the physical commodity, then you can come out with hedging strategies. So just look at that. Will OI, open interest, be decisive to select the strike price? Yes, there are lots of things which are important when you're selecting the strike price. We'll look at that as we go ahead. Strike price, for those of you who are new to the commodities space, the open interest is basically just telling you how many people are connected with the commodity. If there are more people connected with the commodity, that means more people have bought the commodity contract and sold the commodity contract, with be it a call option or a put option. That means there's liquidity in the contract, and if there's liquidity in the contract, you will be able to enter the contract at lower price. What is the price of a commodity? Is the premium. Yeah, so you'll be able to enter the contract at a lower premium if there's huge number of people who are trading at that particular strike price. So here there's something called a combination spread strategy. Okay, so now we are looking at strategies where I don't have the physical commodity. These are basically investor strategies. It involves buying a call and a put with the same strike price and the same expiry date. The minute I'm saying same expiry date, it means it is the same contract. On one particular contract, I buy a call, which is right to buy, and at the same strike price, I buy a right to sell. So I buy a call and a one put at the same strike price and expiry date. I do that because the market outlook is large move in either direction. Risk is limited, reward is unlimited. Risk is limited to what? Risk is limited to the premium paid. Reward is unlimited, it depends on how much the prices move from the current price. So I'm going to do one example here of a long straddle, and then we'll look at the implications of that. Okay, so here it involves, this is a long straddle. Long straddle means I'm buying. Yeah, going long means buying. Going short means selling the contract. So I'm buying a contract, and hence it's a long straddle. So it involves buying a call and buying a put with the same strike price and the same expiry date. So there's a gold options. So I buy a call at 50. So 50 is what? 50 is a strike price. So at the strike price of 50, I'm buying a call and I'm buying a put at the same strike price, which means I'm buying it in the same contract, and I'm paying a premium of 150 for the buy call and 150 for the sell call. So the premiums happen to be the same in this example. So let's see what the outcome of this is going to be. So we'll look at this. So first of all, what might be the price? I have bought a call at 50 and I bought a put at 50. What could be the market price in the future? Okay, do remember when I say market price, in a commodity contract, we actually mean the futures price, yeah, because the underlying for options on commodities in India is the futures. So when I say market price here, is really the futures price. So what would be the market price? So let's assume the market price is this in the future. Okay, I don't know, it can be any one of this, right? Now I have bought a call at 50,000. What is a call? Right to buy at 50,000 rupees. Yeah, I've bought the right to buy at 50,000 rupees. If the market price is 50,700, will I be happy? I have a right to buy at 50. Market price has gone up to 5,700. I will exercise the right and I'll make a profit of 700. I have a right to buy at 50,000. The market price is 45,300. Will I exercise my right and buy at 50,000? No, I will not, because I will buy in the open market at 45,300. And hence, if the price is 45,300, 49,500, okay, this is supposed to be There's an error here, okay? 49,500, whatever there might be. This should have been 49,300. This is going to be, I will not exercise my right here. Whereas here at the top here, I will exercise my right and I'll make some money on the call. Yeah, I'll repeat again. I buy a right to buy at 50,000. The price is 50,500. I will exercise my right. I'll make a profit of 500 there. So if I look at if I fill these numbers in, oh, I put the premiums in. Yeah, so this is 150 and 150. There's a premium. So I put in the premiums there. Now let's look at the call, and this is what it looks like. So this is how the call would look. Right to buy at 50,000. Market price is 50,300. I make money. I'm going to exercise my right, and the writer of the call option will have to sell it to me at 50,000, and I'll have 300 profit for every 10 grams I've contracted. Yeah, the contract size depends on the contract size and number of contracts I've entered into. Look at the put. What is a put? A right to sell. I have the right to sell at 50,000. If the market price is 50,700, will I exercise my right and sell at 50,000? The answer is no. Why should I sell it to you at 50,000 when I can sell it in the open market at 50,700? And hence, if the market price is 50,700, I will not exercise my right. Okay. However, if the market price is 45,300 or 49,500, will I exercise my right and sell it to you at 50,000? Yes, I will, because if I sell it in the market, I only get 49,500. If I sell it to you, because I have a right to sell, I will get 50,000. And hence, this is what the outcome will be for the put contract that I've purchased. So remember, I have bought a call. This is the outcome. I bought a put, and this is the outcome. For the call, I paid 150. For the put, I paid 150. Total, I paid a premium of 300. If I add these numbers, this is what I get. Yep. So I'm 500 minus 300, the premium I've paid, 500 minus 300 again, sorry, 700 minus 300, 500 minus 300, and so on. Now, if you look at what is really happening, if the prices after 1 month or 2 months, whatever the duration of the contract, if they were to rise, the more it goes up, the more profit I make. Yeah. Or if the prices fall, the more the prices fall, the more money I make. Okay. So the point of the strategy here in the combination or a straddle strategy is that my strategy straddles across prices moving up or prices moving down. Now, let me now explain to you how I would be using this strategy. So I might be waiting for like we did yesterday. We were waiting for the Fed in the US to tinker around with the interest rates. The minute they do that, it has an impact on the price of crude oil. Okay, so the minute interest rates are touched, it has an impact in the physical market of the price of crude oil. Okay, so the minute so what happens is the market is looking at how much the interest rate is going to increase. Yeah. So initially they said 75 basis point, then it's at 50 basis point, and so on. So the market factors in these different interest rates by which the Fed in the US is going to increase the interest rates in the US. That in turn has an impact on the price of crude oil. Okay. And if you have entered into a contract in a straddle, then depending on what the outcome is, the prices will move in accordance with that. Maybe it might be easier for some of you if I were to give an example of, say, a copper, because my favorite example, I always give this example of copper. Copper is produced in almost 36% of copper is produced in mines in Chile, in South America. Okay, and couple of months ago, the miners, the union there, the mine union, they went on a strike and they stopped production of copper. Now, when they stopped production of copper, the copper prices started going up. And then there was this news saying that the government in Chile and the union were going to have a meeting. In that meeting, they're going to discuss, they're going to thrash out some of the problems that they're having, and the outcome could be anything. The outcome would be that the miners are satisfied and they would go back into the mines to resume production. Or if the miners are not happy, then they'll continue with the strike. Now, what that decision would be would have an impact on which direction the price will move. If the strike continues, then the price will keep going up because there's going to be a shortage in the market. If the problems are patched up between the mine union and the government, then what the outcome would be that they'll go back and start producing copper, and the price will be expected to go down. So the point here is that these strategies, these straddle strategies, they are many a times referred to as event driven strategies. Yeah, so you can make that note. It's called a event driven strategies. That means I have an event in mind which is going to play out in the future. The outcome of that event will be either prices going way up or the prices going way down. Yeah, so it can, for example, in the geopolitics today, there is a war-like situation still going on in Ukraine. Now, if I come to know that there is going to be some sort of a meeting in which the Russians and the Ukrainians and so on, they're all going to be in part of the meeting to resolve the situation, the outcome could be twofold. One outcome could be that they resolve the issue. The other outcome would be that they still continue fighting, and the outcome of that, it'll either end up in the stock market is going up or the stock market is going down. So if I have identified an event, then I can look at the outcome. So just to give you another one more example so that you will appreciate it even better, we are having a budget on the 1st of February 2023. Yeah, on the 1st of Feb 2023, there's going to be the budget in it. Nirmala Sitharaman is going to come out with the new budget. Now, the outcome of that budget would be accepted by the markets as a wonderful budget, or they might say it's a rubbish budget. Whatever they might say, one thing can happen. One is either the markets will go way up if they think it's a good budget, or it will go way down if they think it's a bad budget. Now, in such a situation, a person should get into a straddle strategy and sit tight and look at the outcome. So in cases where the chances of commodities moving very high or very low are the chances are good, then you will see that you'll end up making money no matter which direction the price moves. So this is an example of a long straddle. Now again, this is called a long straddle because I'm buying a call and I'm buying a put. If I were selling a call and selling a put, then that would be called a short straddle. So I'll look at a short straddle now. So here I'm selling a call and I'm selling a put. Premium is 50 and 50. So this 50 and 50 premium is what has come into I have received it the following morning. Yeah, remember T+1. If I trade today, then the premium has to be paid tomorrow, or if I'm buying a call or buying a put, I pay the premium now today, but on the other side, the receiver of the premium, he gets the premium in his account at T+1, which is tomorrow. Okay, so here is a situation. I've got something called the sell call at 5,000, and he sells a put at 5,000 at 50 and 50 is the premium. The spot price on expiry, these are the prices on expiry. Okay, the PLN, the P&L on call is going to be 50 here. Yeah, so what is happening is here is a writer of a call. What is a call? Call is right to buy. Sell call is forced to sell. Will somebody force him to sell at 5,000 when that somebody can get it in the market at 4,700? The answer is no. So the profit is sitting on a profit of 50. Yeah, I'll repeat again. A call, buy call is right to buy. Sell call is forced to sell. Is anybody going to force you to sell at 5,000? When that somebody can buy in the market at 4,700, and hence you have 50 here. Okay, so 50 is going to be the money that you have received. That is the profit that you're going to make. Okay, now the same thing keeps going on right up to here. So let's look at the bottom one there. So I have a sell call at 5,000. Yeah, I have a sell call at 5,000, which means that will someone force me to sell at 5,000? Forced to sell at 5,000? Yes, somebody will force me to sell at 5,000. Okay, because the market price is 5,300. So what is my P&L impact? Is going to be 5,000 minus 5,300. Okay, less the 50 which I have received upfront, which becomes minus 250. And I do this whole calculation, the payoff for the sell call. Similarly, I can do a P&L for a put. Okay, on a put too, I can do exactly the same thing. So on a put, when I do that, just a moment, I'll just, yeah. So on a, let me just, okay. There's something on my screen which is blocking my view. Right, so there's a, I'm looking at the, on the put side, I'm looking at the what do you call a sell put. So what is a put? Right to sell. What is a sell put? Forced to buy. Someone is going to force me to buy at 5,000. Yeah. Will somebody force me to buy at 5,000 when the market price is 4,700? Yes, he will force me to buy at 5,000. My loss is going to be how much? It's going to be 5,000 less 4,700. Yeah. Plus the 50 I've received by way of premium. So it comes to 250. And on the other side, if the market price, the spot price is going to be 5,300, then that gentleman will not come to me and he will not exercise his right. And hence I am sitting pretty on the 50 profit. Okay. So if I add these, you can see what is happening. So you can see that if prices start going, from 4,900 to 4,008, 4,007, and it's continuously falling, the more it falls, the more loss I make, the more it rises, the more losses I make, and I can only make profit only in that particular range. So what this particular strategy is built on premiums, how much premium I can command. That is number one. Other one is that the commodity that I'm trading, it should be one which is not very volatile. It should not move too much, because if it moves too much, then I might end up down up there or down here. Okay, so you have to look at your commodity, you have to look at the time frame and figure out whether there's going to be volatility at that point in time. Now in this example, it says crude oil, crude option. Crude is very volatile, so I would never use a crude oil contract for a strategy of this nature, because it is so volatile. I'll probably end up there. However, it could still work if my timeline for being along with the contract is for a shorter duration. So when I put this graphically, it looks something like this. But graphical thing is nothing special. It's just that we take these numbers and we just ask Excel to make a chart for us. Yeah. So it's really basically saying that is this particular range from zero here, from 4,900 to 5,100, where I'm above, I'm in profit. Otherwise, I'm below the profit line. Right, so these are combination strategies that I've just now talked about. We looked at straddle, we looked at the long straddle, and I just now showed you a short straddle. Yeah. Now, similar to straddle, there's something called a strangle. Okay. Now, when you talk about a strangle, it is exactly like a straddle. Only difference is when I buy a call and I buy a put for a long strangle. So you can compare the two here on the screen. The market outlook is large, move in either direction. Again, everything is similar. So where is the difference? The difference is that when I'm buying a call and when I'm buying a put, they are at different strike prices. Okay, they're at a different strike price. One of the outcomes or the difference between a straddle and a strangle is when I show the graph, when I show it in a chart form, like we showed you in the chart form here. Yeah. So when you I'm going back again. So when I show you something in a chart form like that, I go back again. Oops. Let me see. Yeah, you can see that that chart which has been formed is formed like a V there. Yeah, it's a V. So it's always in a straddle, you'll always get a V. Whether it is a long straddle, it'll be like that, or in a short straddle, it is going to be inverted. Yeah, so it'll be inverted. Yeah, it's inverted. Yeah. Now, when you do a strangle, because it's at different prices, so I've bought a call at one strike price, I bought a put at a different strike price, and hence the outcome would normally look like a tub. Yeah, the shape is like a tub. because there are different prices there. So large movement in either direction. So the only difference between a long straddle and a long strangle, or the difference between a short straddle and a short strangle, is that while straddles are at the same strike price and expiry date, the long straddles are at different strike prices. So because it's at different strike prices, you end up having a shape like a tub there. So if I look at this particular example, the long strangle, yeah, which means at different strike prices. Okay, so I've bought this particular I bought buy a call and at a strike price of 50,100, and I buy a put at 49,900. So you can see that I bought a call at one strike price and I bought a put at a different strike price. Okay, the premium is 100 that has been paid. So what is the outcome of that? So again, we do exactly the same thing that we did earlier. Yeah, so I have different spot prices here. Now do remember, this is an example. What we are talking about is commodity futures. So when I talk about spot prices, I really mean the future price at which the options contract is going to expire. So here we have got different spot prices on expiry, and I'm looking at the call premiums. So I've paid a premium for a call premium because it's a buy. I've paid 100 there, and again here put premium is 100 there. So I basically paid 200 there. Now let's look at one at a time. What is really happening here? So buy call, I've got a right to buy at 50,100. Right to buy at 50,100. Okay, market price is 49,400, so I will not exercise my right. Yeah, so because so in this particular case, as far as the call is concerned, I am sitting on a loss of 100. Okay, now, and the same thing continues right up to down here. Let's take the last one at the bottom, which is 50,600, and let's do the same exercise all over again. I have a right to buy at 50,100. Market price is 50,600. Okay, then I will exercise my right and I'll make a profit of 400. Okay, so here I'm getting an exercise, I've exercised and I'm making a profit of 400 here. Okay, why 400? Because basically 50,100 minus 50,600, the difference is 500. But remember, I've paid 100 rupees as a premium, so I'm adjusting for the premium, and that becomes 400 there. And I do exactly the same thing for a put. Here I've paid a premium of 50 because it's a buy, because I've bought the put, and hence I've paid 100 premium. So the 100 premium is there. So let's look at how this works out. So what is a put? Buy put is right to sell. Right to sell at 49,900. Market price is 49,400. So the difference between the two, 500. I have a right to sell at 49,900. If I sell in the market, I'll only get 49,400. So I'll exercise my right and I'll get 49,400. 49,400 less 49,900 is 5, but I have paid a premium of 100, and hence my profit and loss is going to be 400. Okay, and these situations at the bottom, prices 49,900 and right up to 50,600, all these prices I will not exercise, and hence I'm suffering a 100 rupee loss which I have paid upfront by way of premium. So here again I just do the calculation, I add them up. So I'm basically adding the P&Ls. So minus 100 and 400, minus 100 and 300. If I come down, see the arrow key, I'm adding the 400 and minus 500. So what I'm seeing now is that there's a big chunk here in the middle, which is showing minus here. That is formed by that tub-like shape. So again, the same logic. If the prices were to continue dropping, the more the prices drop, the more the money I make. The more the prices rise, the more money I make. So difference between a straddle and a strangle is nothing. It's very straightforward, that we are trading at different strike prices. Just an example of a long straddle. So here we have a short strangle. So I'm not getting into the numbers again, but just want to show you that in this particular example again, because we are going short, which means we are selling. So we are selling. What are we selling? We are selling a call at 50,000 and we are selling a put, and hence we call them a short. And because we're doing it at different strike prices, the first call is at 50,000 and the second one is at 49,800. So they are different strike prices, and hence because they're at different strike prices, the premiums are of course different here. You can see for the first contract, I've paid 100. I've received 100, because remember I'm a seller for options. So I'm receiving 100 here, and here for this I'm receiving 90 for that. Okay, so there's difference not only in the strike price selected, but also the premium which has been demanded. Yeah, in one case I get 100, in one case I get 90, and hence I make this particular strategy in this particular manner. So you can see what is happening. It is an inverted tub. Yeah, it's like an inverted tub. So the outliers, that means the prices which are falling, the more they fall, the more losses I make. The more they rise, the more losses I make. If they happen to be in a central area, then I'm making a profit there. So basically, you can use these numbers and try it out yourself. You'll find that it's not very complex. Once you understand that, you get the hang of it. To apply to one situation, you can apply to any situation. Okay, and you can design various strategies based on that. So I look at something on one more strategy now. So this is called a combination spread strategy. Yeah, this combination spreads is a strip. Now, what really happens in the real world is that when I buy a call, and then I have a put as well, then I look at the market situation and I say that there's a chance that the prices are falling. Yeah, they're going to fall. So whenever I have a negative thought that the prices are falling, then I will buy more puts. So suddenly I get a piece of information which suggests that the prices will rise. Then I'll buy a call. When I get information the prices will fall, and I'll buy a put. So in other words, in options, what normally happens is that when people start trading on a contract, they keep buying a number of options contracts, because the amount of money that is required to enter an options contract is only the premium that you pay if you're a buyer of a contract. And hence there's a tendency that every time the market dynamics changes, people try and help their existing situation. They want to bolster their existing situation. So if they find that the prices are, if they think, rather not find, if they think that because of certain circumstances the prices will go down, then they can back up their existing strategy by buying additional puts. So they can buy a put because some news has come which suggests that the price will go down, and then after having done that, a week later they get another piece of information which again suggests that the price will go down, and then they buy one more put. So you can keep doing that because you have flexibility in the options market, where you can keep buying calls and puts on the same contract until expiry. And because you're doing that all the time, at any given point in time you can take a call and see whether you have more calls or you have more puts. If you have more puts, then that combination spread strategy is called a strip. Whenever someone talks about a strip, it means that I have more puts, and I'm buying more puts because seems to be a tendency for prices to go down. So I'm like, here it says direction price movement is likely to fall. So if I am getting information suggesting that the price will go down, I will buy additional puts. Okay, and when I say one call and two put, it need not be one call and two put. It can be one call and five puts, one call and 10 puts, or 10 calls and 15 puts. But in any case, the number of puts would be more than the number of calls that have been entered into. And hence, the minute you have that scenario where you have more puts, then we call that a strip. So let's look at how this will work. Let's look at this example. This is a combination spread. This is a strip strategy, where, so basically here, I buy a call at 100 and I buy two puts at 100. So there are two puts here at the strike price of 100. So the premiums are 2.5. Yeah. so that for all, whether I'm buying a call and I'm buying two puts, the premiums are 2.5. Okay, 2.5 each. All right, so this is what is happening here. So for the call premium, okay, so I have what's a buy call? Right to buy at 100. If the market price is 75, will I exercise my right? No, I will not. So what's my loss? My loss is 2.5, the premium that I've paid. Yeah, I paid 2.5 premium. My loss is 2.5. Okay. Now, let's look at the one at the bottom so it'll become much more clear. I have a right to buy at 100 if the market price is 125. Yeah. Uh, will I buy at 100? Yes, I will buy at 100. I will exercise my right and I'll buy at 100. Why? Because the market price is 125. And hence the difference between the two is 25 is my profit. However, I've paid 2.5. Yeah. So because I paid 2.5, my profit is not 25, is going to be 22.5, which means 25 less the 2.5 that I've paid. Okay, so that is going to be 22.5. And I do the same kind of calculation for any of the situations, just for so that we are on the same page in case you're missing out. Let me just do one more for you. I have a right to buy at 100. The market price is 110. Okay. Will I buy? Yes, I will. I'll exercise my right to buy at 100 because the market price is 110. So how much money I make? 10. But I've already paid a premium of 2.5. So I subtract the premium of 2.5, I get 7.5. Okay, so this is the P&L, the profit and loss on the call. Now let's look at the profit and loss on the put. So I have a right to sell at 100. I have a right to sell at 100. If the market price is 75, which means that if I sell in the market, I get 75. So I have a right to sell at 100. So I will exercise my right and I make a profit of 25. So because I'm making a profit of 25, I have to subtract. So remember, there are two contracts here. There are two puts because it's a strip. So 25 times 2, that would be 50. So it's 50 less the premium I've paid. The premium is 2.5. So it's because it's two contracts, 2.5 times 2.5 times 2.5 is 5. So I subtract the 5 from the 50 and I end up with a 45. So now remember what I'm doing. Each of these positions that I've taken, buy call, the other position is buy put, I'm doing a P&L individually for each of these situations. And once I have done that, I add it up here. So before we add it, let's look at the bottom, right at the bottom for the put. So I repeat, so those of you who have not yet caught on, you get another chance to catch on. I have a right to sell at 100. Market price is 125. So I will not exercise my right and sell at 100. Instead, I will sell in the open market at 125. So as far as this particular situation is concerned, I walk away from the deal. I have made a loss of only the premium. So how much is the premium? The premium is 2.5. And because it is two contracts, so 2.5 multiplied by 2, remember there are two put contracts, it is 5. And hence I put 5 here. Now it's very simple. All I need to do is for the P&L on the call and P&L on the put, I just add the two and I get these figures here. Okay, so you can see that I'm anticipating prices to fall and hence I have bought more puts, which means if my thinking is correct and if the prices do fall, the more they fall, the better off I am because I'm getting more money there. However, if something changes and the prices start going and start increasing, I'll still make money, but maybe not at the same rate as I was if the prices were to fall, because my perception was that prices will fall. And assuming I was right in my perception, prices did fall, I make a little bit of money there. If the prices rose, I'll still make money, but not at the same rate as I would have anticipated for a put. Right. However, in our options, commodity options, you have that flexibility that the minute the market changes, you can, instead of you have one call and two puts, then you can perhaps, if the market is changing, the market dynamics are changing, you could buy more calls. So you will have the opposite situation. You'd have more calls and less puts. And that takes you to the next, when you have more calls and less number of puts, which is opposite of this situation. That is called a strap. So this is called a strip. When you have more puts, we call it a strip. When you have more calls, we call it a strap. Okay, so this is how it would be the entire the payoff would be looking of this in this nature. So one thing is quite clear that when you trade on commodities, that you need to understand the commodity, you need to track that commodity, you must have someone who's following the commodity prices and giving you inputs based on which you can trade, someone you can trust, you can take the positions based on what they are saying, and then you can decide whether you want to get into a strip situation or a strap situation. Someone is asking about how to plan for a stop loss. So you can plan for a stop loss just exactly as you do in a one. Before that, there's one more. Will open interest be decided? Okay, so you can plan for a stop loss based on the direction. So you must decide as to how much loss you are able to handle. So you say I can only handle at a particular point. Yeah. So if the price moves below that or above that, then I can have a stop loss so that my position will be reversed the minute the price touches that. That means the minute the at the money's price. Yeah. So when you're talking about commodity options, we are talking about the at the money price, meaning the future price as of that point in time. So minute that at the money price is reached, then you can say that I would like a stop loss to be put at that price and my existing positions will be reversed. So you can, just like in the stock market, commodity markets too, you can have stop loss positions, different positions for buyers of calls, sellers of calls, because their strategy is different. For writers of put, buyers of puts and sellers of put, writers of puts, you will have different stop loss situations, because each one has got a different what do you call the he's looking at a different outcome. Yeah. So and hence he will design his strategy and a stop loss accordingly. So someone has again put a question here. Yes, somebody says you can always square off any of the legs, or you can add on. Yeah. So suppose I have one call and two puts, and market changes, then I can stick to the two puts, but I can have three calls and two puts, 5 calls and two puts, and then market situations again. Because you're buying here, right? So because you're a buyer, the premium has already gone out of your hand, right? So there is nothing here to do for you to do. All you can do is you can rectify the situations by either converting your position from a strip into a strap. That's what you could perhaps end up doing, because once you're a buyer of a call, buyer of a put, your obligations are already gone, because in the sense you have already paid the premium, so there is nothing for you to do there, but you can actually undo the situation by buying more of the other. Yeah, so you can buy more calls in that situation. Okay. So this is a strap, which exactly involves buying calls. So I'm buying more calls and one put. Again, I'm just trying to tell you, although I say 2 calls, one put, it could be 200 calls and 100 puts, or 2000 calls and 1000 puts. Yeah, it can be. The point of the matter is that you have more calls. Okay, so that's called a strap. So where the market is, your market outlook has changed. Now, just one thing here, I think I probably failed to mention last time also and this time too. So let me just tell you, this market outlook is very, very important when you trade. Market outlooks, what it means is, like, when we go and ask somebody, says, what do you think? Do you think the market will go up? What do you think? Will you think the market will fall? So basically, when you're asking someone, what do you think? And in here in Mumbai, we ask, आपको क्या लगता है, प्राइस ऊपर जाएगा या प्राइस नीचे जाएगा, आपको लगता है मार्केट ऊपर जाएगा. So the point here is, what are you seeking? You are seeking an outlook, market outlook. And whenever you have a market outlook, it can be based on many things. It can be based on somebody you're asking, or it can be based on research. Ideally, you should base it on research. You should base it on people. And what is research? Research is basically It comes from two things. One, it comes from experience. So you have to be with experienced people who understand the commodities very well. Yeah. So research is based on experience, and research is based on actual study of price movements. So you can have a research based on study, and you can have research based on experience. Okay, and that is what will give you an market outlook. So when you ask somebody what do you think will happen, you're basically depending on their perceptions of price movements in the future, because you think that they have more skill. They have either a skill in arriving at those at a price. They can foresee a price in the future, or perhaps because you think they're more experienced in that particular commodity. Yeah, and hence they have a better sight on that particular commodity price movement. So market outlook is very important when you're designing strategies, whether it's any of the strategies we have talked about, and not necessarily in options. It can be also be in futures as well. You need to have an outlook based on which you take positions. The only person who doesn't need to have an outlook when he takes a position is a hedger, because for a hedger it doesn't make a difference which direction the price moves, because his aim is to lock into a price. So he's least bothered. And the person who is an investor, he is the one who's trying to make money. He is the one who is shouldering the risk, and it is the investor who needs to put in the effort to find out the direction in which the price could move in the future. Yeah, and take positions based on that. So this I just got a couple of things here. When you talk about options, we always talk about Greeks. Now, those of you who are new to options, and I think quite a few of you, I'm told, are new to options. And new to options in commodities. Perhaps you are already trading in options in stock markets. First of all, whatever Greeks that you use, if you're using in the stock market, the logic exactly works for the commodity market. Okay, so there's nothing different really. The Other than the fact that in when you're talking about Greeks in the stock market, you're using Black and Scholes model. Whereas when you talk about options in commodities, we use the Black 76 model. So what are these models? These Black 76 model and the Black and Scholes model. These are they've been converted into softwares, or you can do it on Excel sheet. What they do is that they ask for certain inputs, like how many days for the contract to expire. What is the spot price today? What is the interest rates now? So it'll ask you all these inputs into the system, and based on that, it gives you a possible price for an options contract at a particular strike price. So it's giving you a calculated method by which it is suggesting a price at which you can enter the options contract. And what do you mean by price? Price means the premium that I need to pay, or the premium I need to receive. And so this particular premium that I'm willing to pay or I'm willing to receive can be calculated using these models, Black and Scholes in the stock market, or Black 76 model in the commodity market. Okay. Now, whatever we use in the stock market, the same thing is relevant in the commodity market. Only thing is, options are considered to be sophisticated, so we give them the Greeks, right? So for example, change in the price of the underlying. Yeah, in the futures market, underlying is a spot price. The underlying in the futures market is a spot price, and the change in the spot price will have an impact on your perception of the futures contract. Now that is called delta in the options market. Yeah, options market, we call it delta. Delta means what is the change in the underlying price, what is the expected change in the spot price, or what is the change, especially in commodity markets. We don't have a spot, we look at a futures contract price, and hence delta is basically change in the price of the underlying. We call it a delta. Yeah, in the futures market, we just call it spot price. Change in the time period, also commonly referred to as theta. So time period, how long ahead when the contract is going to end, has an impact on your perception of the price in the future. In the commodity options market, we call it a theta. Yeah, the theta means the impact of time on your on the contract price. Contract price, again, contract price is nothing but the premium that you will be expected to pay or you're waiting to receive. Same thing again, Vega. Vega is the volatility. So volatility, does it have an impact on futures prices? Yes, it does. It does also have an impact on prices of in commodity markets too. Yes, it's used for valuation. Someone has said is used for valuation. Yes. When I say the price of a commodity option is the value of the commodity option. Yeah. So when I'm saying price of a commodity option, the price is the premium I pay. And you can use the word valuation there. Yes, sure. Valuation is the same thing. We're looking at the price of that options contract. So gamma, someone has said, what is a gamma? So the rate of change of delta is called a gamma. Okay, so there are, you can, when you're looking at delta, it is the expected change in the price because of the movement in underlying price. And then I'm looking at the gamma, which is the movement in the delta, anticipated change in delta, which is having an impact on gamma. Okay, so we have got delta and gamma based on that. But there's not much impact here. You can also you can study gamma as well, but delta is more than enough and more than adequate in commodity markets. You can look at Vega, like I said earlier, that is your volatility. Theta is the time, and rho is your interest rate changes. Yeah, so changes in interest rates is rho. Easy to remember. R is rate of interest. R for rate of interest. T is as in time. V is as in volatility. Delta is the only one you need to remember, the change in underlying price, and gamma is the rate of change of delta. It's called a gamma. Now the point here is now, so I've just read out something which is a given. Yeah, you need to apply this. How do you apply that? So you have to look at how you apply this in the real world. So when you apply that, let me just see, this is how it is. So let's look at one at a time. So here are some factors influencing options price. Factors influencing options price. Now I can use, somebody used the word valuations, the options valuation. I can use that word as well there. Okay. Rate of change, something I don't know. With respect to what? With respect to change in delta. Gamma, you're asking about gamma? Rate of change with respect to the change in delta. That is what would be the answer there. So let's look at this particular one here, factors influencing options price. Now we are looking at underlying price. Yeah, underlying price. In our case, it is the futures price. Yeah, underlying price is the futures price. So if the underlying price, or we can even look at this in a easier to understand way, the spot price. If the underlying price is increasing, right, then if I'm trading at the same strike price, and if I wish to continue trading at the same strike price when the underlying price is increasing, then for a call option, yeah, when I'm buying a call, the call prices will go up. I'll have to pay a higher premium. The valuation will go up. I'll have to pay more to account for the increase. Now here, maybe I should bring in this particular concept. When you trade in futures, any change in any factor pertaining to the commodity, any change in any factor pertaining to the commodity, yeah, gets absorbed in the price that I'm punching. I want to buy gold at 55,000 in February. I want to buy gold at 65,000 in February. So as I'm punching a price at which I wish to buy in the future, I am factoring in my perception of the price increase that is going to happen, which my perception of the price increase that will happen between now and the point in time in the future. The price increase that I'm anticipating gets embedded in the entire price that I'm punching into the system when I'm buying a futures contract. When it comes to an options contract, I have a strike price at which I'm going to trade. If there is going to be any change in the underlying, that change will get absorbed in the premium that I will be offering. So if the underlying price falls, then I will be offering a lower premium. If the underlying price goes up, then I'll be offering a higher premium. Now that again depends on whether it's a call. In a call, this is the way it would move. In a put, it will move exactly the reverse. If there's an increase in the underlying price, then I will be offering a lower premium. Yeah, so the premiums will have an impact there. So it is always, whether it's increase or decrease in the underlying price, it will have an impact. So if it is increase, so you can see this exactly is happening exactly the reverse in both the cases. When the underlying price increases and the underlying price decreases, the call prices and the put prices, which is the valuations, will move exactly in the reverse of direction in both the situations. Time until expiry. What is time? It is increase in time. Basically, I'm looking at two contracts. I'm doing a spread strategy. One contract is ending next month. Another contract is ending the month after that. Yeah, so I'm trying to trade on two, and I want to offer a premium. How much premium to offer, or I want to receive a premium. How much premium to receive? Yeah. Now, as there is the risk, basically time is, you look at it from the point of view of risk. If there is more risk, because I'm not able to determine the price in February as opposed to a price in maybe April of next year, so it's easier in trying to get a price in February, more difficult in April of next year, and hence there's an increase in time based on the contracts I've chosen, and hence as there is more risk, I have to shoulder that risk by offering a higher premium. So you'll see that, oh, my battery is running low. Can you just give me a minute? I'll just go and fetch my cord. I think there's some problem with my battery here. Just give me a minute. Please just hang on. Yeah, I'm back here. Sorry about that. I just give me a minute, because I don't want to get. Okay. Right, I'm back here. So very sorry about that. Suddenly my laptop just now said that there is a problem with my charge. Okay. I had to run to the next room to get the battery, to get the cord. Okay. So what I was basically saying is that when you're looking at the time until expiry, we're looking at the risk associated with that. Okay. The more the risk, the more I'll have to pay to buy that particular contract. But if there's a decrease in time, and obviously it's going to be exactly the opposite. So here, generally speaking, it's not just one of them, all of them together have an impact. So if I'm going to ask you what's the price of gold in 3 months from now, you're not going to look at only the time, only the volatility, only the interest rate. You look at all in total, yeah? And hence, but any one of the things changes, then your perception changes about what the price is going to be. And as the price increases or decreases in the underlying price, then the premium that you're expected to give or receive will also have an impact. Okay. So when you're trading, so I'm just jumping here, volatility also exactly, it works the same as time. Volatility is risk. The more volatile, the more risk. The more the risk, the more premium is expected. So increase, here if you see that, increase in volatility, more risk, more premium I'm expected. Decrease in volatility, less risk, less premium is expected. Okay, so this is how we look at it. Same with interest rates. Increase in interest rates. So we are looking at, when you talk about interest rates, you look at value of money. So if there's increase in interest rates, the money has got more value, and hence I'm paying less. Someone has put something in chat. Miss the class. When the next class? I we don't know when. Okay, we'll take a call later on. Okay. right? And similarly with strike price also, strike price works exactly the opposite. So I can change the strike price. I can move at a higher, I can move to a, as I move away from the at the money. If I increase the strike price, I go to a different strike price. So that is what people normally do when they trade in options. If the premium is too high at a particular strike price, and if you don't have that kind of money to pay, you can design strategies at a different strike prices where the options valuation, or your what you call options price, is lower. But you can have a straddle or a strangle strategy whereby together you end up in one case you receive money, or in one case you pay money, and accordingly you can have your strategies put in place. Okay, so I end my session here, and I'll take questions from you. I'll stop sharing. So any questions from any of you?
Friends, if you have any questions, you can put them in the chat.
It looks like not many questions coming through. Right, if there are no questions, can we close that?
Yes. Thank you, Mr. Srikanth, for doing this webinar. And on behalf of all the participants, I want to thank Mr. Srikanth and MCX for partnering with us, and for all the participants here. Thank you for joining. Stay connected, and check out this webinar is available on YouTube, so you can check that out, and also connect with us on our socials. And if you find this useful, you can refer Tradeplus to your friends. And there's also a wonderful referral program that is also there with us. You can see the video that is coming up about the referral program. Thank you, friends. Thank you for joining us once again, and wishing you all the best, and waiting to meet all of you in the next webinar. Thank you.